My name is Malie Conway. גדלתי בארץ, אני מדברת קצת עברית, אבל כשזה מגיע למצגת אני עוברת לאנגלית, אני מצטערת, אבל השאלות יכולות להיות בעברית. ROGGE was founded in 1984 by a gentleman called Olaf ROGGE. We manage $36 billion of fixed income, purely fixed income. We have offices in London, New York, Singapore, and Frankfurt, and we are a team of 118 investors. My personal experience, I've been in the business for 29 years. I started my career at JP Morgan Investment Management in London. I then moved for a terribly English company called Rothschild Asset Management. And then about 20 years ago, I joined ROGGE Global Partners to really start anything that had nothing to do with government bonds. So everything that had to do with corporate bonds, investment grade bonds, commercial real estate bonds, and high yield bonds. But I believe someone else is going to be talking about high yield. All we do is fixed income. We don't do equities. We don't do anything else. So we live and breathe the fixed income market, which is extremely important to us. And we therefore are aligned with the success of our clients and the performance of our funds. We have a partnership with our clients, regardless of the size of the account that we have. We manage roughly 70 discretionary accounts, so you can imagine that the average size is significant. We form a partnership with our clients. We feel that it's very important for the investors to look into the eyes of the people who make the decision, people who are investing the money. Hence, I'm here. I'm the co-chief investment officer. I'm the one that basically makes most of the decisions in terms of how the portfolios are structured, how the risks are structured, and then we have a team of analysts and portfolio managers that implement those strategies. So we're flexible, we're customizing to our clients' needs, and hopefully you will see this is a product that we've put together to our clients' needs as yields have declined quite substantially over the last 30, 40 years. We also have a very unique investment philosophy. Unlike a lot of other investment bankers or fixed income managers, we call them merchants of misery. Usually, a fixed income manager would like to see a recession, would like to see disinflation, because then he buys long-dated bonds and the price of the bonds go up. What we do is we lend your money to companies, to corporations, and we want that money back. Therefore, we're looking constantly for healthy companies, healthy entities that for sure will repay your money back. We are trying to minimize the risk of that money not being paid back. So we look at what we call financially healthy companies and financially healthy entities. Where are we today? Where is this environment today? So I don't need to tell you. You all know that yields have declined quite substantially. We've had this massive bond rally in the last 30 years. We've got most governments who are hugely indebted. They have to default on their bonds, but clearly the US Treasury is not going to default on their bonds. So how do they default? How do they take money away from savers? They basically pay you negative real yields. So in an environment that we're here today, where there's very little growth, very little inflation, the nominal yield, the yield that you're seeing on your bonds, is very low because there is no inflation, there is no growth, and therefore you will get paid negative yield. You're seeing that even more so in countries like Japan, in countries like in Europe, where the actual nominal yield is negative. So investors around the world are looking for opportunities to get some kind of real return for their money. Hopefully I will show you an opportunity that you would like that is an alternative and is liquid to real assets. This strategy is basically a real estate strategy. If you're worried about where to put your money, and if you're worried about inflation, or if you're worried about the fact that the Federal Reserve is going to raise rates, what are you going to do? The asset that benefits the most from a reinflationary period is usually real estate, a building, something that you can, real assets that you can actually see, hold, and rent, and get a return from. There are various ways to invest in the real estate market, and you can do it through buying directly the building, which is obviously very costly, time-consuming, etc. You can buy it through the equity market, through REITs. You can buy it through real estate companies that are listed in the stock market. Or you can buy the commercial mortgage-backed security, the underlying mortgage of a building that you effectively own if everything goes bad. You will have a right to that particular building. Why invest now? Why do we look at the real estate market now? The financial crisis has caused significant price dislocation. The structured product market, the real estate market got a very bad name during the financial crisis in 2007 and 2008. And also you have a lot of banks that were sitting on very big properties that had negative loan to values. And basically, as the governments and regulations asked them to delever their balance sheet, they had to start offloading some of these very, very good assets which they have been keeping on their balance sheet. So what we try to do is to take an opportunity and to take advantage of those particular assets that they were offloading off their balance sheet in a bond format. This is a complicated chart, but I'm just going to focus you on two things just to let you know how the market has moved in terms of pricing. If you look at the column that says pre-crisis 2007, and if you look at the second line that says tranche AAA, you had loan to values of 64%. So the bond gave you an equity of the property of less than 40%, and you were getting paid for that tranche only 60 basis points over the government bond market. So your yield pickup was only 60 basis points. As the market went into crisis and as investors repriced the value of those assets, they demanded a much stronger, a much better package of covenants, a lot more equity in the properties that they were owning. So if you look at the last column, today the loan to value is 27%. So you have 70% equity in the building, in the property that you own, and you're getting paid 165 basis points for that, more than 2 times for a much better structure, for the same building, and a much better valuation. Similarly, in Europe, you have the exact different spreads, different pickup, but again, the loan to value improved from 58% to 32%, and your yield pickup moved from 16 basis points to 125 basis points. So you've got a better asset, you've got a better equity, and you're getting paid at least 2 to 3 times more than what you got paid pre-crisis. Why is this strategy interesting? One, it's a short duration, so you're not taking interest rate risk. Most of these structures are floating rate notes, so if the Federal Reserve increases rates, within 3 months the coupon resets to that particular spread immediately. Also, if rates rise, because you don't have duration or length in your bond, the price movement is very, very small. So there's no absolute negative returns. Our strategy is to look at assets globally, across the globe. We're a global house. We currently mainly invested in Europe and the US. I can reassure you that I will never invest in Chinese property, although it's a global bond. I don't understand their mentality. I don't understand their valuations. There will be a point where I believe properties will have value in Japan, but they haven't for 30 years, and I can't tell you when it's going to be in the next decade or so. But this is a fund that is trying to, or a strategy that tries to take advantage by buying prime real estate across the globe. And when I say prime, I mean prime. This strategy looks to buy this is a shopping mall in Westfield in London, which is the biggest shopping mall in the world. This is looking to buy headquarters, for example, Time Warner headquarter, the headquarter of Bank of New York. And each individual asset is valued separately. What we do is we look at the bond. We then send a team, we hire a team, a real estate team in the local market, and we ask them to go and evaluate the building themselves. Now, the rating agencies, S&P, Moody's, will give you a valuation of the building. They will give you their assumptions. But quite frankly, we don't trust it. We want to do the valuation ourselves. So we hire a team of experts locally. We ask them to go to the building, evaluate the building, and give us a current value of the building. We then ask them to evaluate the same building under a distressed scenario, which means if that building had to be sold today and it had to have a severe haircut, how much would that building be worth? We take that distress valuation, we put it through our cash flow models to see how much will we get paid if the value, let's say, went down by 30%. And only if our tranche, the bond that we're buying, is covered by 1.2 times of the value of the building, we will engage in purchasing that particular asset. What that does, it narrows our universe quite substantially because there's a lot of, excuse my language, rubbish out there. But what that allows us is to create a product that has an average rating of single A. It's extremely solid, it's extremely safe, and it's extremely diversified. At the same time, the strategy gives you a pickup versus the government bond market, or call it LIBOR, of 400 basis points for a single A rated diversified portfolio with underlying real assets. So if every building defaulted, you will own a portfolio of very high quality buildings around the world. And for that, you get paid 400 basis points. You also have weekly liquidity, so you can go in and out of the fund on a weekly basis. None of us can buy buildings on a weekly basis. You go in and out of the fund on a weekly basis. If you compare it to the alternative, you can see that even if you went down the credit rating to a double B, you will still get substantially less yield on that. And the double B here, and I have to tell you, is the spread includes metals and mining sector, the oil sector, and some of the emerging market sectors, which have been beaten up quite significantly. So effectively, you're getting quite a substantial carry on your portfolio with real assets underneath that. You can go and visit those buildings if you're in New York, if you're in Holland, if you're in Germany. This is basically what the strategy looks like. These are all technical numbers, but the message is that it has an average credit quality of single A. It has a yield of 4.5%, and it has a spread of 400 basis points. It's mainly invested in floating rate notes. So again, the coupon resets every 3 months, particularly if you're worried about rates rising in the US. And we can talk about Yellen, whether she's made a policy mistake or not, or what the Fed is going to do. But effectively, I like it because it's a liquid alternative with real assets that are supporting this portfolio that you can evaluate every month and you can know exactly what you've got. So just to sum it up, it's a portfolio that has very little exposure to interest rates in an environment where rates are very low. It has exposure to very high quality assets in the portfolio, which are real assets. It protects you from increase in interest rates and inflation, because what happens in an inflationary period, if nothing happens to the portfolio, the assets that you own, the value of it will increase, hence the loan to value will decrease, so your quality of the portfolio is much higher because you have more equity in the portfolio. It gives you liquidity, a weekly liquidity, as an alternative to the asset class, which is usually very illiquid, and usually the fees are very high to go into real estate funds, usually locked for 5 to 7 years. It gives you significantly higher yield, and more importantly, it has lower volatility than other fixed income asset classes as a protection. So as a diversification, as a liquid alternative, this is a strategy that we've put together about in 2013 for our clients. And you can see how the fund has performed. If you invested $1 in October 2013 with this fund, you can see how stable the returns are. Compared to other asset classes, it's really competing in terms of return with double B high yield, short dated double B high yield but look at the volatility you're getting for being exposed to a high yield market. And that's obvious because it's highly correlated to growth, it's highly correlated to risk aversion, to liquidity. So you can see a very stable outcome of this fund since inception, and we expect it to continue to behave very, very steadily. This strategy should generate somewhere between 3 to 4% in our view in 2016. We recommend it to our clients as a proxy to cash. Instead of putting your money in the bank on a deposit where you're getting 0 or possibly negative rates in some parts of the world, this is a very good alternative to that. So that's why.
What about the fee structure?
The fee structure. The fee structure is 50 basis points all in. We're not expensive. For the institutional class? Yes.
Will it help if I do some shopping at Westfield?
It won't hurt. Please do come. It's always good to support what you own. Thank you very much.
Thank you.